Thanks for joining us on Power Lines. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Indian equities continue their upward momentum. Nifty tests the 11,700 mark, while Sensex is firmly above the 39,000 mark.
The Supreme Court strike down Reserve Bank of India's February 12th circular. The two-judge bench has found RBI's actions ultra-virus.
The Reserve Bank of India will conduct a second forex swap worth $5 billion on the 23rd of April.
The Congress releases its manifesto, says focus is on 5 big themes of minimum income guarantee, jobs, agrarian stress, education and healthcare.
All right, all of that coming up with perspective, but let's first dip in with the markets. Yatin is here with us. Afternoon, Yatin.
Good afternoon, Ira. Nothing much on the key indices. We are almost flat on the Nifty at this point in time. Advanced decline ratio also looks, quite, similar to what the market is. Flat 1:1 is the kind of advanced decline ratio on the Nifty 50. What's doing well in trade is Tata Motors. Of course, their March monthly numbers were not that great. But after the 8% move yesterday, that positive trajectory is continued even today. Stock is at the day's high, 6% up for that one. Not only that, Eicher Motors, after appointment of Vinod Dasari, who was the former MD CEO of Ashok Leyland, has seen some action off the day's high, but 2.5% higher for Eicher Motors at this point in time. On the flip side, we have the likes of Bajaj Auto, Britannia and Grasim, which are the top losers on the Nifty at this point in time. What's active in trade is, SBI, 1.5% up for that one. Also, we have the CPSE ETF, which has seen some continued buying, and also it is moving in the positive trajectory since we have a lot of PSU stocks moving in the positive side. On the mid-cap size, we have Raymond, which is quite active in the future and option segment, almost at the day's high for that stock after we have seen some intraday yo-yos. There will be press meet in which they are talking about some strategic initiatives. The stock is quite active in the future and option segment.
Yatin, thank you for that. The big story today, the Supreme Court has struck down the RBI's February 12th circular. The Apex Court, which was hearing a plea filed by 3 different sets of aggrieved parties, the two-judge bench has found the RBI's actions ultra-virus, which means it's acted beyond its powers. Arpan Chaturvedi and Vishwanath Nair are here to take us through the details. Arpan, you go first. What does this judgment really say?
That's right, Harsha. So, what are the reasons behind the judgment? We don't know yet, because the order will be uploaded in a while on the Supreme Court website. But as far as what happened in the court is concerned, the judges entered at 10:30. Justice Nariman, who was heading the bench, just spoke one sentence where he said that they've held the RBI Feb 12 circular to be ultra-wise. Now, what exactly are the reasons? Which arguments of the petitioners have been accepted? That we will figure out once we see the judgment. But as far as the arguments of the petitioner is concerned, the first and the most important argument that they based their case on was that it's a violation of the circular is in violation of Article 14, which is the right to equality under the Constitution. The petitioners had argued that that the RBI circular takes a one-size-fits-all approach, which basically means that they do not take sector-specific issues as far as the defaults are concerned. And they do not also make space for genuine defaults when such defaults occur. The other arguments that they took was that the RBI circular also is contrary to laid down laws such as the Insolvency in the Bankruptcy Code, the Banking Regulations Act, and other such laws. So these were the 2 main arguments on which the petitioners had made their case. Now, what case, and of course the RBI had opposed the arguments, and they had said that they had done their detailed study, and after that only the circular was formulated. But as far as what arguments of the petitioners have been accepted and what have been rejected, for the detailed analysis of that, we will of course get to know once the judgment is uploaded on the Supreme Court website in a few hours.
Arpan, thanks so much. Much will come through in those details, as you said. But Vishwanath is joining us here for a banking sector impact. Vishwanath, what exactly does this mean for the banks?
So as part of the February 12th circular, the RBI said that action needs to be taken for 2,000 crore and above accounts with that much of exposure. Now, according to an ICRA study, that pool is about 3.8 lakh crore. Of which about 2 lakh crore is just from the power sector. That's about 70 large borrowers that were being impacted because of the February 12th circular. Now, what part of this has already gone into NCLT, what part of it has been resolved by bankers within the 180-day timeline that was given, all of that is not clear yet. That is something that the analysts will find out. But then, it is important to note that part of the circular, that was the most contentious part, was that bankers need to start taking action immediately as soon as the first default happens. Earlier, banks had that 90-day period after which the account was classified as an NPA, and only after it became an NPA would they get into action and try to resolve the account. But the RBI insisted in the February 12th circular that action needs to be taken from the beginning, which meant that there was some kind of discipline that was brought into the credit market, in the loan market. And this is something that the RBI has time and again defended as to why it made this decision. The impact of that was that SMA 0 accounts, which is accounts which have been in default between 0 and 30 days, that had actually come down in December as compared to where it was in March of last year. And that number coming down itself shows that people were regularizing their payments. They were trying to cure their default and get out of the whole resolution process, because otherwise banks will have to implement some kind of a restructuring plan. So if the companies repay that amount, then of course that whole problem goes away. So that discipline was getting built into the market. We still need to see whether removal of this will, push banks back to their earlier days of, only acting after an account becomes an NPA. Another issue was with the invoking the IBC, protocol, where 180 days, if you're not able to implement a restructuring plan, the company has to go into IBC. So now, without that sort of deadline looming over banks, the restructuring procedures could get extended. You could see banks, not really rushing to try to resolve the account within that 6-month period because there is no IBC threat that is looming around. Banks could take the decisions themselves as to which accounts should go into the IBC, but of course, banks have historically, ever since the IBC came into existence, banks have been wary of invoking it because there is considerable pain, and of course, recoveries have not been that spectacular.
Okay, we also spoke to a bunch of experts on this issue to understand what this means legally and for the banking system as well. Let's listen to what they had to say.
The discretion and the absolute discretion to take a debtor into the insolvency process or to wind the debtor down was with the banks. And it is the banks which must take that decision based on rational considerations. Now, that was being removed. That rationality with the banks was being removed. And there was an external impetus or stimuli by the RBI to say that you will necessarily take the companies down the restructuring route or the insolvency route at the end of 180 days. So that fiat or that certainty to say that you will necessarily take them to IBC is now gone. The banks have now come back to taking a decision based on the ex-ante regulations that are available.
If you really wanted to scrap the mandatory requirement to take it to NCLT, that should have been done. But the scrapper circular really means the following. One is the banks are left with no other options. And as we know, government sector banks especially need specific RBI guidelines to fall in place. You come back to SDR and S4A, which have known to not succeed. And the reason they did not succeed is because they were too stringent and prescriptive. Almost the same reason why the Supreme Court has said that do not be prescriptive on taking it to NCLT.
It is not an impact in terms of provisioning or NPAs, not really impact in terms of accounting of the banks. But from the resolution perspective, we expected that there will be some fast tracking of resolutions because promoters will come forward, banks will be eager to implement a resolution plan. So those possibly now will not see maybe a sort of a sense of urgency to resolve these assets.
Certainly it will take the winds out of the sails of the banking system, because February 12th circular was a great enabler for the banking system in the sense that it was enforcing certain level of credit discipline. Now, the reasons for the striking of the February 12th circular as deduced by the power sector, the sugar sector, the fertilizer, or the shipping industry was that there were things beyond their control which were within the purview of the state, which would have been taken up cognizance of by the regulators. These are two separate matters, but certainly the banking system will have a setback.
All right, we will come back to that big story, but let's move on for now. Bajaj Auto bucks the trend to report a strong sales growth in March. The rest of the car, bike and the commercial vehicle makers continue to struggle with muted demand. Yatin Mota standing by with the numbers that have been trickling in. Yatin.
Well, as you mentioned, Bajaj Auto, the numbers were broadly in line with the street expectations. Of course, the export market gave a fillip. Also, what came out post-market hours yesterday was Tata Motors, which delivered, the total local sales at a little over 68,000 units. Again, a flattish kind of a growth year on year. And more importantly, their medium and heavy commercial vehicle sales were down 9%, and the passenger vehicle segment sales were down 12%. So that clearly speaks that how weak are the consumer sentiments, especially to do with the passenger vehicle segment, and that was acknowledged by the company. Hero MotoCorp, again, a big, negative surprise, 20% lower sales in the month of March year on year. And the company said that, the lower wholesales this time in the month of March would mean that the inventory levels would come back in control and probably reduce at the dealerships, which was the need of the hour. And probably, the management also probably indicated that the production was adjusted in such a manner that the inventories get cleaned up moving forward. Eicher Motors, of course, we have Vinod Dasari, former MD and CEO, joining the company because of which the share, price was in action early morning. However, if you look at the Royal Enfield sales, the total sales declined by nearly 20%, to come in at a little over 60,300 units odd. Of course, if you look at the 350cc segment or, the, models which are 500cc and 650cc, all of them saw, a decline of, of 20% odd. So not great going for Eicher Motors. There was expectation that some sales would recover, but that's not really happening on the ground given the muted sentiments ahead of the elections.
Vinod Dasari, he's shifted from Ashok Leyland, has moved to head Royal Enfield. What does he bring to the table?
It's a very interesting thing to watch out for because, Vinod Dasari was at Ashok Leyland for nearly 14 years. He joined as a COO, from which he got elevated finally to a position of MD CEO. More importantly, not only did he, improve the distribution network, use cost-cutting measures to improve margins, but he was also, able to bring down the debt levels and manage the balance sheet well. For Royal Enfield, this is a clear value add, given the fact that, Vinod Dasari would be based out of Chennai. They had various labor unrest issues in Chennai plant for Royal Enfield. We had a couple of strikes there. Probably, Vinod Dasari does really have the expertise to handle these situations versus a Siddhartha Lal who was based out of Delhi.
Right,
More importantly, a lot of people would report to him from the marketing side.
Yatin, thanks so much for that. Just going back to our top story on the Supreme Court striking down the February 12th circular, Mr. Cyril Shroff, managing partner at Cyril, Amarchand Mangaldas, is joining us on the phone line. Good afternoon, sir. Thanks so much for taking the time to speak to us. So we don't have a detailed judgment, but it certainly looks like the entire circular has been struck down. Your first thoughts?
Yes, I have not seen the judgments, and I'm not in India just now, so I'm just sort of relying on sort of what I've read in the media. So that with that disclaimer, I think 3 points. Firstly, I think it's a very significant development that the Supreme Court has struck down this circular. And I think the practical implications will be on two things. One could be sort of mitigated by further circulars by RBI. So there are really two parts to it. One was the deadline within 6 months of the payment default for compulsorily referring a case through the IBC process to the NCLT. So I think it takes that gun off the head of both from the debtor as well as the banks. Now, that being said, I think the banks can still voluntarily submit cases, and I think having tasted blood at the IBC, I suspect that many banks will still be inclined to take the IBC route regardless of the absence of the 12th February circular. So that's thought number one. Thought number two is in relation to the provisioning norms. So clearly, as you know, the 12th February circular also had various provisions for how, once the cases have been submitted, how the provisioning should be made. Now, assuming that has been struck down as well, I believe it would be perfectly within the sort of jurisdiction of RBI to make new provisioning norms or to sort of deal with it in the normal course of business.
in terms of how they sort of regulate the banks for how they should be provisioning in various situations. So I think that has to kind of work itself out. But it's a moment to sort of reflect and ponder, to think about, whether the whole scheme of, we started a couple of years ago, whether there has been sort of too much regulatory over-enthusiasm, and just pause and think about how to do it a little bit more cautiously. I think that's my first reaction. But again, this is from a distance without having read the judgment.
Mr. Shroff, does this have any ramifications on cases that have already been resolved, in the sense that can let's say, companies that have lost their assets go ahead, promoters who have lost their assets go ahead and challenge this in a court of law?
I don't think so, because I think the cases have been validly resolved under the once you're in the IBC process and it's gone through the normal course. I would not think so. But that being said, somebody can have a go at it and raise this issue. So I wouldn't be surprised if somebody were to challenge the existing references to IBC having been originally bad in law, because the circular itself has gone now. But if something has already been resolved, it would be very difficult to unscramble the egg.
Just taking that thought further, sir. So, for instance, in the NCLT1 and NCLT2 list of accounts, there too the RBI had directed banks to take those companies to insolvency, and some of them are still not resolved. If the principle is that the creditor, the bank, should have the discretion to make this decision and not the regulator, then that principle could be applied even to NCLT1 and NCLT2 cases, sir.
One should wait to read the judgment before now, because that's a slightly different situation where the sort of 12 plus 28 cases and how they've been referred, and I think it requires some more scrutiny to see whether what the Supreme Court has said today could apply to the original reference on the 12 plus 28. I would be cautious in going that far.
Mr. Shroff, just a larger question, because you know the regulatory domain, the legal domain as well. It seems like this is a large in some ways a challenge to the Reserve Bank of India's ability to regulate the sector the way it deems fit. Now I know that the fine print will come out in the order, but it does seem like a blow to the RBI's overarching control over regulation on the sector.
That is true. That is true. But again, I don't think we should read so much into it that it's kind of a death blow or not. I think it's just basically making the broader point that everybody who operates within India, whether it be regulators or the private sector, is subject to the rule of law. And it's always the law is, whoever you are, the law is above you. I think it makes that point rather well.
All right, Mr. Shroff, we'll leave it there since none of us have the details of the order. But thanks so much indeed for that quick reaction. That was Cyril Shroff. Let's move on to another story related to the Reserve Bank of India. The Reserve Bank of India will hold another forex swap auction worth $5 billion on the 23rd of April. This comes after the first auction conducted in March drew a strong response. Remember, the central bank has been infusing liquidity in the banking system through various measures, mostly bond purchases, mostly the open market operations. But it now looks like they are going down the forex swap route. About 35,000 odd crore gets added through the $5 billion that get purchased. Joining us now to talk about that is Anant Narayan, Professor at SP Jain Institute of Management. Anant, thanks so much for joining us. Appreciate you taking the time. Actually, we were hoping to talk about the broader liquidity framework, but this came out of the blue yesterday evening, so I'm going to start with a question on that. Rather quick off the block for a second swap auction, so it really looks like they think that is a route to go down, and perhaps better than OMOs at this stage, maybe.
Well, yes, I guess having tasted success in the first round, which happened last week, RBI has decided to continue with this. Personally, I think it's a good route to use. First, it does ease interest rates and liquidity into the entire system for that 3-year tenor where the infusion happens. Second, it uses the FX route. To that extent, it actually doesn't touch the bond market. I've had issues with the RBI's excessive use of open market operation purchases, which I think distorts the bond market quite egregiously. FX is not a bad market to impact at this point in time. As a side effect, what happens is you make it cheaper for importers and borrowers of ECBs to hedge in the forward market. Given that rupee is currently overvalued right now and is seeing a lot of FPI and FDI inflows, that might not be such a bad thing. I would only caution that this tool as well, like every other tool, has to be used cautiously. One of the byproducts and side effects of this tool is that it does make it cheaper for people to buy forward dollars. So if we, God forbid, go into a situation where there's a panic outflow of dollars, effectively the RBI would have made it cheaper to actually panic and buy dollars, more dollars than what would have otherwise been possible. So every measure has to be used in the right measure. For now, this is absolutely fine. This does seem to make overall macroeconomic sense.
What is your assessment of the liquidity right now, Anant? And more importantly, does this in a sense reduce the scope for further OMOs? Is it needed at all at this juncture?
Asha, I think there's always a need for a proper liquidity framework to be established in this for our policymakers. We have a monetary policy framework. A liquidity policy is an absolute adjunct to that monetary policy, as for that matter is a foreign exchange policy. What I mean by a framework for liquidity is, first we have to decide what do we want the liquidity to look like. Do we want it to be in surplus, in neutral, or in deficit? And that's a conscious choice that has to be made. Second, if you're actually doing intervention in liquidity markets to change the liquidity, do you want that impact to be short-term or do you want it to be durable? Third, every tool that we use to manage liquidity has a side effect, either in currency markets or in bond markets or in macroprudential stability. A conscious judgment has to be taken about what the likely side effects of the instrument of choice is, and we have to ensure that those side effects are acceptable. All these three have to be established. At the moment, if you ask me, I'm not convinced completely that we should go overboard on liquidity. Yes, the policymakers should retain that flexibility to have surplus liquidity if required. But higher liquidity brings lower interest rates, transmits rate cuts much better. I'm not sure all the stresses we are seeing in the system, whether it is power sector, whether it is select NBFCs, whether it is certain sections of the debt capital markets, airlines, and so on and so forth. All these sectors really require lower interest rates. What this shouldn't become is using higher liquidity and easy interest rates as a palliative to relieve actual stresses which require real reform, recapitalization, and restructuring. You shouldn't let that happen. Yes, the policymakers should have the option to choose, but this has to be used extremely carefully. This has macroprudential ramifications if you go completely into excess.
Two questions, and you've written part one of a two-part series, so we'll wait to see what your conclusions are. But, one question is, and one thing that you're hearing from the market a lot these days, is that spreads are elevated because you're too tight on liquidity, both the spread between the repo rate and, say, the 10-year bond, and the spread between the government securities and the corporate bonds. The counter-argument to that, at least on the corporate bond side, is that you've seen a credit shock, and perhaps some of this is normalizing now. They were depressed earlier, and they're normalizing. But the market is convinced that no, this is a liquidity problem and the RBI needs to tackle it. What would you say to that?
Well, Ira, as I said, this should be debated within a proper liquidity framework. My own personal take is the following. Yes, given the size of open market operation purchases of bonds that the RBI has done over the last fiscal, it is surprising to see 10-year bond yields still at pretty elevated levels, 7.26 or wherever it is right now. But the reality also is that there are concerns around the fiscal deficit. There are concerns about the size of the borrowing program. There are concerns about demand-supply mismatches, and the market is reflecting those particular concerns. So I think there's a good reason why government bond yields are where they are. On corporate bond yields, look, I think good corporates are getting funds at reasonable rates in relation to where the government bond yields are. Government bond yields have to come down for their rates to come down further. And for that, the crowding out which is happening by the overuse of the fisc has to be managed. Yes, there is a problem as far as names which are stressed are concerned. So if there are certain select NBFCs which have a certain trust deficit around it, there are credit concerns about putting in money into that particular entities. Now, those really cannot be sorted out by merely infusing liquidity. So as I said, we have to be extremely careful about injecting too much of liquidity and pushing the economy into our banks into lending a lot. That is an absolute carrot and stick. If you push in liquidity, banks will be looking out to lend as much as they can, and they might start to make compromises on credit. They might start to make compromises on macroprudential, safety. So you have to be conscious of that. You don't want people to start, supporting stress sectors merely by liquidity. In a way, it can actually put off the real reform which is required in the power sector, for instance, or in making NBFC books a lot more trustworthy, for instance. And in the worst case, because banks start to jump in and compromise on credit, you could actually end up with a financial stability problem for banks at a later stage. So this has to be used very, very cautiously. I think the problems that are there right now, while it looks like transmission issues, I think a bunch of them have nothing to do with liquidity and interest rate. They have to do with genuine reforms and capital and restructure which is required for certain assets, and we have to separate between these two issues. But again, this has to be deliberated under an overall liquidity framework, which unfortunately we don't have in the country.
Anand, just a last question. I know again this is better discussed, through a proper written out article. But broadly, do you think we need to rethink the use of the call markets as an indicator that the RBI uses to assess liquidity conditions? I know what will replace call markets is probably a far tougher question. But do you think at least that needs to be rethought?
Oh, absolutely, Ira. So look, we've always had an issue with liquidity being measured by a price risk measure. The first thing you learn in academics and risk management is liquidity risk is very different from price risk. When we complain of liquidity, to look at a price measure like a weighted average call rate and say everything is fine absolutely makes no sense at all. So we've been talking past each other. RBI has been looking at WACR or weighted average call rate. Banks have been referring to asset liability mismatches. Good borrowers have been referring to the lack of transmission, and stressed borrowers have been saying, just give me funds at whatever cost. So everybody's been talking about different things when it comes to liquidity. I think we have to all agree that when we talk about liquidity in the RBI and the banking sense, we're talking about the amount of surplus money available with banks at the beginning of the day, and what they do with it, and what incentives that extra money actually puts on into the system. And as I said, there has to be a choice between keeping the systemic banking liquidity either surplus, neutral, or deficit, based on the actual monetary policy stance, whether it's accommodative or neutral or tightening. So there is a need for that framework. And absolutely, I think the metrics have to change. WACR doesn't make sense because it doesn't capture what the market means when they talk about liquidity issues. Transmission and asset liability mismatches are the real issues, and we do need better metrics to measure that.
Anant, always a pleasure. Thank you so much indeed for joining us with your perspective. Anant Narayan from SP Jain. Politics now. The Congress party has unveiled its manifesto for the elections 2019. The focus is on 5 key themes, including a minimum income guarantee, which they've already announced, farmer welfare, education and health. None of these issues are relatively new. The promise is to do some welfare measures launched by the government. Let's talk. My colleague Tamanna Inamdar is here. We'll also be joined by Aditi Fadnis. Tamanna, why don't you talk me through what stood out for you?
Well, like you said, the top 5 points were largely known because they've been announced. But now that I'm looking through the manifesto, there are a lot of details which would be very interesting. For example, there's a proposal to de-link the definition of MSMEs, or rather to link the definition of MSMEs to labor. So you would be defined as a small or medium enterprise depending on how many people you hire. Of course, the whole Fasal Bima Yojana will be reworked. That's their promise, will be linked to public sector insurance companies on a no profit, no gain sort of a system. So there are a lot of granular details that we'll go into as we go along. Needs a bit of detailed reading. But yeah, there are departures from what you've seen in an average manifesto. And one thing that struck me, Harsha, is over the last few elections, even general elections, manifestos have become one of those things that you kind of just have to put out, and not with so much of thought into it. This is clearly a detailed exercise that they've gone through. They've taken about a year to do it, and they claim that they've got experts on board, etc. Of course, the big question is, do manifestos win elections? I'll come to Aditi Fadnis for more on that. Aditi, welcome. Your first sense of what you saw in the manifesto, and remember in the press conference that followed, a number of journalists asked Rahul Gandhi again and again that, okay, you've got this manifesto, you're talking about jobs, etc. But the narrative on the other end is about national security and divisive politics. How are you going to combat that? And he said, no, I'm sure that it's jobs which is the biggest issue. What was your sense after seeing that presentation and the press conference that followed?
Well, like you, I'm still looking at the manifesto and the fine print, and some of the things are really interesting. We don't know, for instance, what the new revenue generation stream will be, which will finance 6% outlay for education. The scheme is supposed to be, this 72,000 rupees is supposed to be financed by the center and the state together. So that's a nice way of avoiding having to do it in states where the Congress is in power. Thirdly, I think this manifesto cannot be, I mean, the ownership cannot be anyone else's but P. Chidambaram's, because the fine print is thoroughly thrashed out, and it's not a manifesto that that enables you to make it up as you go along. One thing leads to another, leads to the third, leads to the fourth. So it is in that sense an organic document.
Aditi, the focus on the agriculture side is pretty very clear. One, the focus on a possibility of an agriculture budget, the fact that Rahul Gandhi announcing that, farmers who won't repay loans, the offence will not be criminal anymore, it might be considered as a civil offence, and so on. The question is, again, connected to what Tamanna was asking you, do you think this is going to resonate on the ground when the narrative on the other side is so strong?
It's very hard to say what is going to resonate, because it's only just come and people will, I suppose, discuss it and talk about it, and congressmen will go and explain it in simple terms as to what it actually means on the ground. Whether ultimately this will overtake the whole discourse of nationalism and Pakistan and terrorism, whether it will overtake it, it's very hard to say at this point. But certainly it's a very well thought out, very thoroughly argued document, and that in itself is it's something which should give people some reassurance.
A couple of interesting points as I'm going through it is, for example, they say that all 4 lakh vacancies as on 1st April 2019 in the central government, central public sector, enterprises, etc. will be filled before March 2020. They also talk about increasing the contribution of the manufacturing sector to the GDP from 16 to 25% within a period of 5 years. So as Aditi said, there is a lot of granular data in it.
I really wonder how they'll manage to do that.
Yeah. My point was, Aditi, does this in a sense also put pressure on the BJP to come up with as detailed a manifesto? We've seen that the BJP has not really focused on this manifesto exercise, and it's worked for them over the last few elections. There was one election in which they released the manifesto a day before counting one of the state assembly elections. And over the last few days, people have also been telling me that the BJP will have to come up with some sort of a counter to the income guarantee scheme. So can we then expect a more detailed manifesto from the BJP this time around?
Well, last time also it was quite a detailed manifesto. The question is not the detail, the question is how it all ties in together. You can do random things, or you can do, you can promise things that that will catalyze and energize the next step in the economy and society that you are planning to take. So in that sense, the BJP manifesto, even in 2014, was a set of random steps. The difference is that this manifesto of the Congress links every step with the second step, and incrementally promises escalation or promises progress. So I'll be waiting bated breath for the BJP manifesto and how it stacks up against this one.
Aditi, the whole Nyay scheme seemed to be their big political bet. Is that something that, again, anything else that stood out in the manifesto for you? Do you think this is going to sort of give them political dividends?
I'm not sure if it's going to give them political dividends, because people like to see what they've got, the rupee anna pie of what they've got, rather than the promise of what they're going to get. So the BJP has already given 2,000 rupees, and I'm told, I mean, wherever we have gone as part of the election campaign coverage exercise, we have found that people have been quite enthused by this scheme. Of course, there are many who feel that it's very small. It's a very small sum of money which really doesn't affect them one way or another. But in our country, 500 rupees is still a lot of money for a lot of people. So and it's free money. So it does have a certain traction. In contrast to that, what the Congress is saying is, in the future, if you elect us to power, we'll give you this. So now that's a very it's a pie in the sky, as it were. If the BJP had done nothing and the Congress has promised this, it would be one thing. But the BJP is doing something, and people continue to believe that if prodded in this direction, there will be more goodies to come in the future.
Aditi Fadnis, we'll leave it there. Thank you so much indeed for joining us with your perspective. Aditi Fadnis from Business Standard. Out of time on the show. Thank you so much for joining us today.